Okay, this is the deal I want to talk a little bit about today. It's the this is a it was a very interesting syndication that I did with some partners back in about I'm trying to think 2010 2011, and it was about a four year hold, and it was two seasonal land lease communities, which is kind of a fancy way of saying mobile home parks that people would go to in the summer. And so these were not places that people lived at. They could only kind of occupy them for 6 months out of the year. And because the topic is really around debt today, I thought that, you know what, I gotta make sure. Okay, good. My audio is working. I thought that this deal would be really useful to kind of explain commercial real estate and how there's really like no one way to do it. And so I think sometimes what happens, and I'm going to go off on a bit of a tangent here, and you're going to see why. This was unplanned, so hopefully I don't go too far off script, if you will. But I think what happens with people that are used to investing in stocks or have kind of studied that kind of academic, value investing, growth investing, looking at, financial statements and just really kind of technical analysis, if you will. When they get into commercial real estate, even though there is certainly a process, and I mean, I've got a very kind of documented approach that I use when I'm finding, financing, fixing properties. The reality is every deal is different. And so what happens is how you finance those deals, how you find those deals, how you negotiate, all of those variables, there's a bit of an art to it, if you will. And so I thought today what I would do is show you a little bit on a little bit behind the scenes, if you will, on a deal that I was part of. And I'm not going to take credit for this negotiation because I would have never even considered it. But now that I've seen it, I can see how I would apply it to future deals. And I've actually used a similar negotiation on a different deal. So in any event, the deal was two land lease communities in Muskoka, which is just north of Toronto. One was 1,100 acres, the other was about 53 acres. And we purchased both properties, even though they were two separate owners. The one owner at Shamrock Bay, he came in as a partner and actually invested money into our deal. So that lowered our requirement for equity. The second deal was Bonnie Lake, and it was, this is a very crude drawing, if you will, but it was essentially 1,100 acres with a 200-acre lake in the middle. And what we did on that deal, because the purchase price on it was, I want to say it was about $6.5 million. And because it was very difficult to get any type of conventional financing because for a few different reasons, which I'll get into in a minute. We were kind of stuck, if you will, on how do we finance this property and or how do we buy it so that it makes sense to us, because on the north side of the property is where all of the cottages were, okay? And this is kind of the clubhouse. You can tell I'm a horrible artist. And so about 550 acres, and there was 11 different parcels of land, okay? So everything, I just kind of separated it from north and south. On the north side is where all the cottages were, all the development. On the south side is where we thought we could put development, but that was going to require going into the town and getting rezoning for that, which was a risk to us. And so when we were sitting down with the vendor in this case, we explained kind of our concern, if you will, and we wanted to have some certainty or some ability, if you will, that if we could not develop the south side, that we could essentially either renegotiate with the vendor or potentially give back that south land. And that's really what the vendor take back was structured as. I mean, Here's the thing. In commercial real estate transactions, both sides are generally quite sophisticated. So this was not like you're trying to kind of pull a fast one on someone. The vendor basically said, look, you're looking for an option on the south land. And while that wasn't our intention by any means, because quite frankly, we wanted the entire site, and really quite a bit of the value would have been attributed to redeveloping this south side, we still wanted that somewhat flexibility, if you will. And so what we did is we purchased it for $6.5 million. We put cash of $4 million, and then we had the difference, which is $2.5 million. I'm just going. I'm pretty sure these are the numbers. And so on the north side, we put a $1.25 million vendor take back mortgage, and I don't remember the exact terms. It would be in this pitch deck, but the terms are not that important. Let's just say it was a 5-year term, meaning in 5 years we would have to pay it back, and the interest rates we negotiated were very attractive. I want to say they were like 3 or 4%, so they were very low. And I believe even in the first 2 years we had no interest payments. Okay, so and then on the Southland, what we did is we had a similar structure. Although, if I'm not mistaken, the vendor, because like I said, they knew what they were doing. They wanted to have some of the principal paid back on an annual basis, and I don't know what the exact numbers are. Let's just say it was $100,000 a year. So at the end of each year, to keep this mortgage intact and in good standing, we would pay it down $100,000 a year. So the reason I bring this up, this kind of creative structure, is that, like I said, in every commercial real estate deal, there's going to be nuances. And as the buyer, you want to reduce your risk. As the seller, you want to get the maximum price, and you want to kind of get your money as quick as possible, generally speaking. Now, this vendor take back mortgage, obviously it helped them out from a tax perspective, and it gave them some cash flow while they got a big chunk of money on day one, the $4 million, and then they got paid out over time for the balance. And at the end of the day, we paid out both vendor mortgages actually when we sold the properties. So it worked out, and it was just a very creative way to structure a very complex deal. Had this not come together, and this was actually my father-in-law, I remember sitting in the meeting, and we were kind of like we were in a boardroom, and we were basically at a complete standstill. And I'm thinking, this deal's not coming together, because we couldn't get over the fact that we were paying too much money essentially for a property that had so much uncertainty. And so when this structure was kind of outlined by Andy, all of a sudden the vendor knew what we were trying to achieve, and we got what we wanted, they got what they wanted, and we were able to move forward and put the deal together. So and at the end of the day, the deal itself worked out very well. I will say that one of the reasons we had to structure this type of financing, if you will, with vendor take back mortgages, all cash, is because of the nature of this real estate investment. Because they were land lease community, this was a land lease community, the leases are renewed on an annual basis. And so most lenders looking at this, they saw that as more risky than if it was a mobile home community where the leases were longer. Number two, there wasn't enough cash flow. Our plan was to actually renovate and do a bunch of different things on this property, which we did. Some of the, obviously, residents, they don't like change, and so you have to kind of be prepared for people to move out. And so we had some people leave, and that's part of it, right? So kind of year one, cash flow goes down. We're having to invest heavily into this development. So there was a lot of capital that was required to go in. And so you've got two things. You've got cash flow going down. You've got more equity having to go into the deal. It's a development, no long-term leases. And so at the end of the day, most banks just said, you know what, we're not going to lend on that. So we were essentially raising money from our investors at anywhere from kind of 10 to 12%, which is expensive, and time then becomes your enemy. So, I mean, at the end of the day, I could easily write a book, and on this one deal, well, actually, you can see just our presentation on this, which I would definitely change in the future, was about 45 pages. So that's kind of the amount of research and due diligence that went into these two projects. But you know, at the end of the day, it was a $8.5 million deal that we eventually sold for 17. So you know, it was complex. It was big. I learned a tremendous amount about marketing, sales, finance, cash flow, operations, partnerships, you name it. This deal here basically gave me a, I don't know what you want to call it, pretty much a PhD in syndicating and doing commercial real estate developments. So that's what I wanted to talk about on that deal in terms of more creative structures. Today, I want to now transition into what I really focus on, which is focusing on finding more conventional debt. And what I mean by that is there's kind of two different types of debt. You've got kind of conventional, which is your tier one banks, and then you've got secondary debt, which is think of it as more expensive, short term, mezzanine. So these are some of the terms people will say or throw out when they're talking about non-conventional or tertiary or secondary debt. You've got mezzanine or mezz loans, you've got bridge loans, you've got mix of the type of mortgage investment corporations that will lend money that typically charge higher fees. They will lend money much faster, and there's just a lot more flexibility. Whereas when you go to a bank, think of it like even if you were to buy a house, for example, if you go to a tier one bank, an RBC, Scotiabank, BMO, really doesn't matter. They're going to give you the most attractive rates, but they're also going to ask for the most information from you. Versus if you go to a private lender, they may just say, you know what, we'll give you 80%. We're going to charge you 12% on your money. The loan is good for 1 year, and you're going to pay 3% fees. And if you don't pay us back in 12 months, then we take your property. Now there's, in the commercial world, there's a very good reason for doing something like that. Typically you would be looking to what's called normalize or stabilize the income, right? So if I'm doing a value add property, something like this, and I had a clear path to be able to kind of raise the income from say $100 to $200, once I hit that $200, I can go into the bank and say, you know, Mr. Lender, can you lend me more proper financing at say 3.5%, 4.5%. Those are the rates today. Obviously, you know, they vary. But that would be the reason for using secondary lending or bridge or mezz debt, if you will, to basically, that's what they call it, bridge financing, to be able to get you to where you can get conventional takeout financing. Okay, so, but one of the, where I typically start, because this is a question I get quite frequently, which is, you know, how do I raise equity? And I generally start with, well, how much debt do you have today, or how much debt are you able to raise? And the reason that's such an important question is because a few reasons. Number one, if the banks are comfortable and like the deal, it's going to be much easier for you to then go to your investors and say, hey, I've got a tier one bank that is prepared to lend 75% or 70% loan to purchase price. That is going to, in my experience, it gives a lot of credibility to the project that you're looking at. And so the banks are going to ask a few different questions, but I'll just kind of break it down into kind of three buckets, if you will. So number one, the banks are going to look at the property and what is the cash flow today. So that's kind of like bucket number one. Bucket number two, they're going to look at who the borrower is. And let's say you might have partners, right? Typically with my deals, I do have partners. And they're going to want to look at my experience. They're going to look at my net worth. They're going to want to know my reputation, right? And that is, if you don't have a reputation, it can be one of the reasons why you may want to partner with someone that does have a reputation and experience in commercial real estate. Okay, so that's just something to keep in mind. And then number three, the third bucket, if you will, is the down payment. And that is really kind of the skin in the game. I know that there are people that talk about getting into commercial real estate with no money down. It's not something that I necessarily have experience with. There's certainly ways that you can get in with less money. And when I say less money, because I typically raise money from investors to come into my deals, they're not no money down, but they're less money for Shane, if you will. So I would typically tell most of my clients that if they're going into a commercial property, to expect to put anywhere from 25 to 35% down. It doesn't have to be all your money, but just expect that this is not like buying a house where you can get in for 5% or 10% down. Now, I will say that some lenders, especially if you're buying, say, an apartment building, CMHC will lend up to 85%. But it's 85% of the value that they determine on that property. And so let's say you're buying 20 unit apartment building for $2 million, but CMHC says, well, that's fine. But based on our underwriting, the way that we look at the financials and the numbers, we think that property is only worth 1.8 million. So they're only going to lend 85% of 1.8 million. So I don't have a calculator right now, but you'll soon see that you're going to get scaled down to probably having to put in about 25% equity. So not all cases. I just want to kind of make you aware of that anyways. A few important terms that I think most new investors into commercial real estate should be aware of. I'm not going to get into too many of them, but I think the key terms are probably the biggest one is DCR or DSCR, which is your debt coverage ratio or your debt service coverage ratio. And that is really the ratio of, if you remember, we talked about NOI on a previous episode, and NOI is your net operating income or your net income. And that's just your revenue minus all your expenses. So whatever the money that you're left over with. So in this case, let's just say that your top line revenue is $200 and your expenses are $75. Your NOI or your net income is going to be 200 minus 1 or 75. You're going to end up with $125. Now, if you need what's called a 125 debt service, that means 125% of the mortgage payment you need to be getting in or collecting in income on the property. So in this case, if you've got $125 of net income, the bank would say, we'll lend you up to $100 in mortgage payments. Okay, so that's essentially how much your mortgage payment could be. So depending on what the interest rates are, how long the amortization, the term, those are going to influence how much you're going to be able to lend or borrow. But essentially, this debt coverage ratio or the DCR is really going to constrain how much money the bank will give you. So I know that may be kind of, it may sound a little confusing if you're just listening on the podcast, but if you Google DCR or even just download my clubsyndication.com scorecard, I go into this in a little bit more detail. Okay, so that is the first term that I think is really critical for new commercial real estate investors to understand. The second is recourse or guarantees. And in the US, my experience is that yes, they are non-recourse, but it doesn't mean that the banks are basically saying that no one has to sign off, because they have what are called lie, cheat, and steal clauses. And so essentially, if you're unethical, they want to be able to go after someone. That's number one. They still do look at your net worth. And so you may be able to get non-recourse, but in my experience, you still need someone with substantial net worth to be able to sign off on the actual mortgages. In Canada, generally speaking, like these are generalities because there's always variations. And that's why I never like to say always or this is a rule. But in my experience, you're typically going to sign, like when I do development ground up, I'm signing full personal guarantees, my partner and I. If you are buying a cash flowing asset, let's say an apartment building or a retail or like a shopping center or an office building, you may be able to get away with if you put more equity into the deal. So let's say maybe you put 35% down versus 25% down. The lender may say, okay, instead of full recourse or 100% guarantee, right? Let's say I'm borrowing $5 million from the bank might say, we only need you to guarantee 50% of it, okay? So that would be a partial guarantee or partial recourse. So just it's really important to understand those kind of to go in with proper expectations, because some people are very averse to putting personal guarantees, which I totally understand and respect, and is why some investors say, you know what, Shane, I'll let you take the risk. You go out and find the property. You put your personal guarantee on it, and I will invest as a limited partner where I have no trailing liabilities. I have no recourse. Like, the bank doesn't go after the limited partner; they only go after the general partner. So that is just an important distinction, and I think that we'll kind of leave it at that. So we've already talked about the two types of debt. Obviously, you've got conventional, which are your big banks, long-term, typically low risk, lower fees, lower rates. Then you've got your secondary markets, which are, like I mentioned, your bridge financing, your mezzanine debt, and your mix are the typical lenders. And they're going to be, generally speaking, much faster. They're going to have more expensive fees, anywhere from kind of 1 to 3, sometimes 5%. They're meant for short term most often. And so what that means is anywhere from kind of like 6 months to 18 months, maybe 24 on the outside. And if you need to renew with them, they're going to charge you fees again. So it's just important to understand that. They can typically act much faster, and they're more flexible. They're probably still going to want guarantees because they are operating on a faster basis. So just important to understand that. The different ways that you can secure commercial financing, you can go direct to banks. And I will say that because I've got a good relationship with our banker, we have historically gone direct. What I would say though is that on more complex deals, or if I had no experience, because you may or may not know, but I started off my career in commercial real estate as a lender, and so I was at Sun Life, and we were lending kind of 250 to 300 million a year. So over my 3-year time with Sun Life, I got a lot of experience with, what banks look for, how to finance, how to underwrite deals. And so I've got that background, but even with that background, that was about 10 years ago. And so much has changed that I still go to brokers today, to get a pulse on what's going on in the market, because things change and lenders' appetites for risk and what they look for. I mean, the commitment letters that we had 10 years ago, I'm sure that they have changed quite a bit, or at least enough that it would be important to have someone with experience to look at that on my behalf. So you will pay a little bit for a mortgage broker, but what they are able to do and bring to the table, especially for new investors, I think is vital. And on that, I will be interviewing probably a lender and a broker in the upcoming episodes. I've got a broker lined up, super good guy. We've had a few conversations, just trying to coordinate our schedules to be able to bring him on. And I'm going to ask him obviously some questions that I think you might be interested in. If you do have kind of specific questions, because I've already got some, like, should I invest in a corporation? Should I invest personally? How much money do I need down? Some of the questions about recourse. Send them to me, let me know, and then I'll make sure that I ask Chris when I get him on the show. The last thing I do want to talk about, because I know we're kind of coming up on the where I like to keep these episodes, is typically you're going to get a term sheet. So think of a term sheet from a lender as your letter of intent. This is non-binding. It's just high level, right? In terms of what they would do if everything kind of works out the way that you presented it to them. From a term sheet, they will then go to a commitment letter. And a commitment letter is going to spell out in very specific terms what the lender would do in terms of the debt that they would give to you. And so on a typical commitment letter, it's going to spell out what the interest rate is, not the actual interest rate, because what they do is lenders, they price off bonds. And so that might be a bit confusing, but let's say the 5-year Canadian bond or US Treasury is at 2.5%. And the bank is going to say, okay, well, we're lending at a spread of 140 over bonds. Okay, so 140 would be 140 basis points or 1.4%, right? So if the bond is 2.5 plus 1.4, 3.9%. So that is typically how the interest rates are set. That's important to understand. So you're going to see kind of what the spread is, right? You're going to see likely what the leverage or loan to value will be. Obviously, they're going to put in there, provided it hits 125 or 135 debt service. They're gonna spell out all the terms of the deal. They're gonna show you what the amortization is, how long the mortgage is, and then how long there's the amortization and then the term of the deal. So it could be a 5-year term with a 25-year amortization. Very similar to when you buy a house. And then there's going to be bank requirements, the type of insurance you need, what kind of if there's an appraisal, environmental, building condition, all that kind of stuff is going to be baked into this commitment letter. Super important to make sure that you read that in detail, because you're going to be bound by it. And just because you get a commitment letter doesn't necessarily mean you're going to meet all the requirements. So you really want to make sure that you go through that. So that's really what I wanted to talk about today. I know it's kind of a crash course. Literally, people spend like 10 years to really understand commercial finance. So it would be quite difficult to try to compress that into kind of 25 to 30 minutes. But what I thought I would do is in this kind of short amount of time, give you the big picture, right? And then show you what's possible, right? Vendor take back mortgages, conventional versus secondary, the different types, if you will, of lenders, and what you're going to be looking for with respect to either term sheets, right? Your LOI, if you will, from the lender versus an actual commitment letter. I didn't get into fees because fees vary so much that it's it really wouldn't make a lot of sense. But just understand that there will be fees, and in commercial finance, it's expensive to secure the money, if you will. But you're also borrowing millions of dollars, so you're just playing at a different level versus on the residential side. The resource really for today is my scorecard that I created, because if you come in prepared and with a complete kind of binder and checklist, if you will, of the property, of who you are, when you present that to a lender or your broker, you're going to be much further ahead, and they're going to treat you like a sophisticated investor versus someone that's coming in with a shoebox full of information and kind of hoping that the lender is going to take the time to really understand it. So the more prepared you can come in, like I said, the 3 buckets, right, that we talked about, which is the property itself, the cash flow, who you are as the borrower, and then where your money is coming from, your down payment. You're going to be much further ahead. And I think that if you can kind of take the approach that you're building a relationship with whoever it is that you're dealing with, whether it's the broker or your lender, you're gonna find it a much more enjoyable experience. It's not going to be enjoyable, but it's going to be more enjoyable when you go to your bank to secure that financing. So that's all I got for today. Hope you enjoyed. We'll see you next week. Bye for now.